Welcome to today's Explainer. We're going to completely strip away all that complex financial jargon and finally uncover the realistic truth behind building long-term wealth in India. If you are actually focused on understanding how money grows, instead of just chasing the latest quick tips, well, you are absolutely in the right place. Let's dive right in.
You've undoubtedly seen these flashy, super alluring advertisements. They pop up literally everywhere, promising astronomical wealth from tiny, almost insignificant monthly investments. They make it sound like you're going to be retiring on a yacht by next Tuesday. Or, maybe you've heard a friend casually mention, hey, just start an SIP and all your financial problems will be solved. It sounds incredibly tempting, doesn't it?
But let's look past the slick marketing illusion for a second and ask ourselves a really critical question. Can a systematic investment plan alone actually magically make you a crorepati, or is it just another overhyped financial buzzword? Today, we are going to separate the myth from the reality and look at exactly why thousands of really enthusiastic investors end up quitting way before they ever reach their financial goals.
Section 1. The Big SIP Myth.
So a lot of folks actually scratch that. A huge number of people falsely believe that an SIP is an investment in and of itself. But an SIP is simply a method. It's literally nothing more than a set of standing instructions telling your mutual fund company to invest a fixed amount of your money every single month. It is not an asset class like gold or stocks or real estate.
Think of it kind of like paying your electricity bill. Your payment method, whether you set it to autopay through your bank or you do it manually every month, that doesn't dictate how much power you actually consume or what appliances you can run, right? In the exact same way, your SIP doesn't actually generate the wealth. It's the underlying equity, debt, or index funds that do the heavy lifting and put your money to work.
Section 2. Why recommend SIPs then? Now, you might be wondering, if the SIP itself isn't magic, why do financial experts constantly recommend it? Well, its true power lies entirely in investor psychology. It effortlessly forces you to build 3 unshakable habits: discipline, market consistency, and something called rupee cost averaging. Every month, the money just gets invested automatically. No excuses. The daily news changes, the market goes crazy, but your investment continues smoothly in the background without you having to make a single emotional decision.
Let's break down the math behind that third habit, rupee cost averaging. Say you invest a flat 5,000 rupees every month. In January, the price is $100, so you get 50 units. But look at February. The market takes a hit and drops to 80. Instead of panicking like most people do, your automated SIP goes on a massive discount shopping spree, buying you more units, 62.5 of them to be exact. And when the price jumps back up in March, it automatically buys fewer units. It completely removes that incredibly dangerous temptation we all have to try and time the market.
Section 3. The Real Wealth Creators.
So, if the SIP isn't the wealth creator, what on earth is? Real wealth is created when fundamentally strong businesses grow their profits within an expanding economy. Just think of the companies whose products you use every single day. As their corporate earnings increase, their share prices generally rise over long periods, which then increases the value of the mutual funds holding them. Your SIP? It simply keeps adding more fuel to this economic engine year after year.
Here's a really simple way to look at it. Your SIP is just the monthly watering schedule. It keeps the plant healthy, makes sure it doesn't dry out, but it is the tree itself, the underlying mutual fund investing in strong companies, that eventually creates the fruit. You can have the most perfect watering schedule in the world, but if you plant a dead seed, you're getting 0 fruit.
Section 4. The magic ingredient, time.
But even the healthiest tree needs one crucial, invisible ingredient: time. Picture investor A, who starts at age 25. By simply giving their investments decades to sit in the market, time does the heavy lifting, allowing the returns to compound on top of previous returns. Then you have investor B, starting at 45. Now, they might have a way higher salary and can invest aggressively, but they can literally never buy back those lost decades. Investor A completely outpaces investor B simply because they let compounding work its magic way earlier.
Because compounding really needs 3 distinct pillars to act as this incredible wealth multiplier. You need the capital, you need the decades, and honestly, most importantly, you need patience. If you interrupt your time horizon, or you lose your nerve and pull your money out during a scary, volatile year, you break the pillar and the entire wealth creation process drastically slows down.
Section 5. Wealth-destroying investor mistakes.
Now, unfortunately, a lot of enthusiastic investors totally sabotage their own journey by falling into a few highly predictable traps. It's crazy, but the most damaging mistake people make is stopping their SIP during a market crash. We just talked about rupee cost averaging. A crash is precisely the moment you should be accumulating the most units at steeply discounted prices. Other massive traps include expecting to magically double your money in 2 years, withdrawing funds to pay for short-term desires, and fundamentally, never stepping up your SIP amount even as your salary grows.
Section 6. Maximizing your wealth. So, going all the way back to our very first question, yes, becoming a Corpati is absolutely possible over a 25 to 30-year horizon, provided you follow these practical steps. Earning reasonable long-term market returns works wonders if you step up your contribution by just 5 to 10% annually. You have to align your funds with your true risk tolerance so you don't panic, totally ignore the daily financial news cycle, and simply let compounding do its work through all the inevitable ups and downs.
At the end of the day, an SIP is basically just a highly reliable car. It's automated, it's super efficient, and it's going to keep moving forward. But you are the driver. Your discipline, your patience, and your emotional control during market crashes dictate the entire journey. Your final financial destination depends completely on your ability to stay on the road without taking unnecessary impulsive detours.
So think about your own financial journey for a second. Are you actively driving, or are you kind of asleep at the wheel? Take control. And hey, let us know in the comments below, when did you actually start your first SIP, and what initially motivated you to begin? Are you starting early, or are you playing catch-up? Thank you so much for joining me for this explainer. I really look forward to exploring our next topic with you. Until then, stay focused and keep learning.